Cameron, a lot to unpick here. For one, it's not exactly like there was a lot of volatility to step in. The sell-off had been quite orderly. And two, the U.S. decides to do this in euros. What do you make of this joint intervention?
Yeah, I think it says it's more about the level of the yen than the rate of change. Normally, the rate of change is a primary consideration, but we got as high as what 164 or something in dollar yen the other week, and that's you're talking 30 plus year, 40 plus year highs for a country like the U.S. that's trying to narrow its trade deficit. That makes it quite difficult, and for Japan that is struggling with an inflation problem, is struggling with the problem of how to manage the long end of its government bond curve, given inflation and given the impact of the currency on inflation. It kind of makes sense in that regard. Now, why the U.S. has done euros is an interesting question, and I'll be honest, I'm not really sure why they've decided to do that, because it's not like the euro is massively out of line in either direction. So it would have seemed to have made more sense, I think, for the U.S. to have sold dollars, because after all, the U.S. has a dollar printing press.
Well, most of the explanations for why this joint intervention took place focus on the idea that the Bank of Japan needs to raise interest rates faster because the interest rate differential is causing the yen to fall. But there also is an argument, isn't there, that the flows from Japan have been heading overseas for many, many years, the retirement flows, the government investments, and they need to change some of their domestic policies to try to keep money at home.
Yeah, it's absolutely the case that the BOJ has been raising interest rates, but in an extremely measured fashion. They met at the end of last week, and while they signaled that they're going to go in September, they could easily have gone. They could easily have gone last week. You also make a very good point about the lack of home bias when it comes to government bond investors. And what's interesting is that for domestic Japanese bond investors to capture higher yields, say in the treasury market, they can't hedge the currency if they do that, because essentially they lock in a negative interest rate. Certainly a lower interest rate relative to what they can get at home. And so the alternative is to buy treasuries and other foreign bonds on an unhedged basis, which obviously has a currency implication. They buy dollars, they buy euros, whatever, and they don't bring the money back. They don't hedge the currency back into yen. And that is one of the reasons why we've seen this move in the yen, as well as sort of the negative terms of trade shock from higher energy prices resulting from some of this Middle East stuff. Now, there has been some speculation that the GPIF, which is the big, huge public pension fund in Japan, is going to alter its asset allocation to a higher JGB weight. And the thinking is that the private sector pension industry would follow suit. If they do that, that would certainly encourage less of an outflow from Japan to other bond markets, and on the margin, obviously, would imply an inflow if they reduce their foreign bond holdings to bring the money back home. Now, what that might mean for the Treasury market is another question, and there the answer might not be so pleasant for Scott Bessent and his colleagues at the U.S. Treasury.